for the European Code of Good Conduct for Microcredit Provision. This module covers topics on essence and structure of the European microfinance market, as well as the diversity of the microcredit providers. The module will analyze microcredit lending practices depending on the type of institutions providing microloans, and will also set out good practice guidelines in identifying expectations and common standards. The plan of the topics will be customer and investor relations, governance of microcrediting processes, risk management in microcredit provision, reporting standards, and management information systems. The information sources, web page, and informative materials of the European Microfinance Network, material from European Code of Good Conduct for Microcredit Provision by the European Commission's Directorate General for Regional Policy. And we have used also the European Commission's Directorate General for Regional Policy, Global Resource on Financial Inclusion, Microfinance Gateway. So customer, investor, and investor relations. Microcredit providers have clear obligations toward customers and investors. The well-being of customers is intimately linked to the mission of microcredit providers to combat poverty and social and financial exclusion, while private and public investors are increasingly important in the funding of the sector. Hence, establishing principles that guide the treatment of customers and principles that ensure transparency and reliability in dealing with investors is of great importance. This section of the code sets out a series of obligations incumbent upon microcredit providers towards their customers and investors. This includes a fair and transparent lending process, right to address avoidance of customer over-indebtedness, protection of customer data, and transparency vis-à-vis of investors. So customer relations, with sufficient information provided to the customer, the microcredit providers will disclose lending costs in their advertising. This will include borrowing rates, charges, and illustrative examples. This clause has been identified as a priority clause because disclosing the cost of borrowing is crucial in enabling the customer to make informed financial decisions. The annual percentage rate of charge must be disclosed in a credit agreement and in any advertising. This refers to the annual value of all the commitments, drawdowns, repayments, and charges, including fees and taxes paid by the customer and known to the creditor. Microcredit providers will provide pre-contractual information to the customer and set it up in the credit agreement. They will identify the geographical address of the lender, the amount, the duration of the credit agreement, the borrowing rate, the total amount payable, charges for late repayments, right of early withdrawal, debt collection practices. For loans of duration of 12 months or longer, microcredit providers will provide clear and accurate information to their customers about their loan in an annual statement. The annual statement must include the amount paid, the interest and the principal amount, the balance left, and the structure of the remaining payments, timing, amounts, interest, and principal. The annual statement may be transmitted electronically, on paper, or face-to-face. Microcredit providers will take adequate measures to ensure that customers fully understand the product's process and terms of the contract. This may, where necessary and appropriate, include training customer-facing staff to communicate effectively with all customers, reading contracts out loud for visually impaired or illiterate customers, or providing materials in local languages. So the customers have the right to either withdraw within 14 calendar days of the signing of the credit agreement or repay their loan in its entirety without incurring extra costs within 14 calendar days of the signing of the credit agreement without having to give a reason. This clause has been identified as a priority clause because it is an important and widely recognised customer right. This right will be enshrined in the credit agreement. Customers will be given adequate time to review the terms of the contract and given the opportunity to ask questions and get answers prior to signing. Customers have the right to early repayment through the microcredit provider can claim compensation for reasonable costs linked to early repayment. This right will be enshrined in the credit agreement. The costs linked to early repayment should also be set out in the agreement. Customers have the right to have the credit history they accumulate with a microcredit provider reported to National Credit Bureau and databases where these exist. Where applicable, this right should be set out in the credit agreement. This is so that customers can build a positive credit score. This clause only applies in countries where National Credit Bureau and databases collecting positive credit history exist. So avoiding over-indebtedness of customers. Microcredit providers will assess repayment capacity and loan affordability on the basis of sufficient information from the applicant, database, and/or competitors. At a minimum, this must involve calculating the customer's working capital, business, and household surplus, and assets and liabilities. It should include an investigation of the capacity to carry forward the product. In that sense, referring to internal business development services or external partners to assist in the assessment is considered good practice. Microcredit providers will have credit policies which give explicit guidance on borrower debt thresholds and acceptable levels of debt from other sources. The credit policy may indicate debt thresholds as a percentage of or a range of percentages of disposable income that a borrower can reasonably be expected to manage. This should be based on a realistic assessment of disposable income, allowing for fluctuations and including an allowance for other debts. If there is significant non- or underpayment exceeding 1 month's credit, the microcredit provider should inform the borrower without delay of the non- or underpayment through the appropriate medium. This will include the amount involved, the borrowing rate, and penalties, charges, or interest applicable on arrears. So microcredit providers have the responsibility not to mislead investors. For example, they cannot say that financial promotions are subject to regulation by a statutory agency if this is not the case. Microcredit providers will give relevant information enabling investors to make informed decisions. The extent and nature of risk must be made explicit and clear, and transparent accounts and reports in accordance with the reporting standards laid out in the European Code of Good Conduct for microcredit provision will be made available. Microcredit providers will make it clear that any investment in the institution is risk capital and not equivalent to deposits. Microcredit providers will endeavour to target prospective investors equipped to understand risk or have access to external professional advice related to investments. Microcredit providers offering fixed, low-cost shares as a form of membership, such as credit unions, are exempt from this clause. Microcredit providers should take the necessary steps to verify investors' identity to prevent money laundering. For individuals investing, this is done by acquiring their name, photo identification, and place of residence and birth. For companies, one would have to check company registered details and details of their directors. So the governance of microcrediting process. According to the Handbook for the Analysis of the Governance of Microfinance Institutions, governance encompasses all the mechanisms by which stakeholders define and pursue the institution's mission and ensure its sustainability by adapting to the environment, preventing and overcoming crisis. Strong and accountable governance structures are of great importance in microcredit institutions, as they ensure that providers are driven by clearly setting out roadmaps and that they do not deviate from this course. This is particularly important for preventing mission drift. This section covers business planning, the role and responsibilities of the board and management, and external audits. The development of a business plan. The microcredit provider will produce a business plan that is reviewed on a regular basis, at least once a year, and updated if necessary. This clause has been identified as a priority because a business plan may serve as a roadmap that sets the direction of the organisation and guides its policies and strategies. The components of the business plan are set out in Clause 3. The business plan will cover a minimum of 3 to 5 year period. The business plan will, at a minimum, cover the following aspects of the business: its mission, goals and objectives, customer and product mix, including piloting and rolling out any new products and reaching out to new customer groups, delivery model, including current and future staffing requirements, delivery partners, legal and institutional form, including any proposed changes to the legal and institutional structure of the institution, detailed budget and forecasting, including income, expenditure, bad debt, provisioning, cash flow and balance, funding, including revenue and capital funding, identification of key risks and how these will be managed. Microcredit providers will commit to measure, disclose and improve their financial and social performance. Microcredit providers will measure and disclose the financial and social performance indicators stipulated in reporting standards in the European Code of Good Conduct for microcredit provision. Microcredit providers will use management control and performance tools in business planning. This will, at a minimum, include budgeting and variance analysis, for example, calculating difference between budgeted and targeted expenditure and revenue. The use of such tools should be evident in the business plan. So the independence of the board, all microcredit providers will have a board of directors or equivalent body. This clause has been identified as a priority clause because having a board is an essential part of ensuring the sustainability of the provider and that it is fulfilling its corporate mission. The board or equivalent body should have a known membership and a chairperson, have regular meetings covered by written minutes, and comply with the clauses set out in the code. The board will have an audit or supervisory committee. The committee should have a membership named by the board and have regular meetings covered by written minutes. The audit or supervisory committee will be independent of management. Representatives from management should be kept to a minimum and constitute only a minority of members of the audit or supervisory committee. The audit or supervisory committee will have expertise in financial analysis and accounting. The board of large microcredit providers will have a minimum of 7 board members. Small and medium microcredit providers will have a minimum of 5 board members. In its consensus statement on corporate governance, the Council of Microfinance Equity Funds suggests that 7 to 9 members are ideal and common. Fewer than 7 is not advisable, as the quorum becomes small, especially if a representative of management is on the board. The majority of board members will be independent. This means that the majority of a board should not be composed of any combination of management, staff, customers, or their immediate family. This clause has been identified as a priority because having an independent board is crucial to ensuring effective oversight of the provision of guidance to management on strategic issues. Cooperative and mutual providers should strive to ensure that any combination of management, staff, or immediate family does not make up the majority of the board. Selection of chairperson and board members and any remuneration they receive will be decided by the General Assembly, the annual general meeting, or the highest body within the organisation. The election of the chairperson and board members should be included in the minutes of the General Assembly or the annual general meeting. The effectiveness of the board will be reviewed periodically by the General Assembly or the annual general meeting or equivalent body. The performance and effectiveness of the board should be raised as a specific agenda item, and the discussion should be covered in the minutes of the General Assembly or the annual general meeting or equivalent body. So the responsibilities of the board will supervise the performance of the executive management. The performance of the senior management should be raised as a specific agenda item during at least one board meeting annually. This will include discussing the performance of executive management and key management functions such as planning, organisation, and the implementation of plans, human resources, leadership, direction, and control and monitoring. The board or equivalent body, as defined by national legislation, is accountable for the compliance of the microcredit provider with relevant laws and regulations. The board will ensure compliance in liaison with the person responsible for the internal audit function. The board, on a regular basis, reviews whether a microcredit provider is fulfilling its mission and business plan. This should be discussed at board meetings on at least an annual basis. The discussion should include whether the institution is reaching its target group and achieving its financial performance. The board monitors financial indicators on a regular basis. As a minimum, this will happen on a quarterly basis. So the risk management in microcredit provision. Microcredit providers face numerous risks that threaten their financial and institutional viability and long-term development. Their portfolio may suffer sudden rises in loan delinquency and arrears. Providers may be subject to fraudulent loans made by their loan officers. Therefore, it is imperative that providers have robust systems and procedures for identifying, assessing, and prioritizing risks, internal controls for preventing or detecting undesirable outcome, for example, credit committees, and an internal audit function for uncovering breaches of internal controls and fraudulent behaviour. This section of the code sets out common standards for the management of credit, fraud and security risk and for the internal audit function. So the risk management framework, microcredit providers will have formalised and explicit processes and procedures in place to identify, to assess and to prioritise risk. This is essential in reducing the likelihood that a loss occurs and minimise the magnitude of the loss that should it occur. These processes ensure that risks are examined and assessed regularly. This may involve having regular management meetings to discuss risks, using perhaps a risk matrix or register. A risk matrix or register identifies risks, determines the likelihood and the severity of the risks. Is it low, moderate or high? And produces an aggregate risk profile combining the measures, so the likelihood and severity. It may also incorporate the quality of existing risk management in terms of controlling the risks. A senior member of the executive management will be accountable for risk management within the institution. This clause is also a priority because management sets the tone for the approach to risk and internal control in the organisation. It is important that the staff members responsible are not operational staff, such as loan officers and administrative staff. Instead, it should preferably be the chief financial officer. In larger organisations, the person given overall responsibility for risk management should not be involved in operational activities, but should instead be dedicated to risk management. Microcredit providers will have a clear and explicit assignment of responsibility for the implementation of risk controls and ensuring that they are respected. Risk controls are ex-ante mechanisms built into the organisational design, procedures and daily operations to ensure acceptable levels of risk. Typical risk controls include policies requiring dual signatures on loans to reduce credit risk and risk of fraudulent lending, and safes, vaults or security guards to protect cash and other assets. The responsibility for the implementation of new risk controls and ensuring that these are respected should be assigned to a specific staff member or post. The provider may decide to make different staff members and posts responsible for different risks and controls. It is important that the staff members responsible are not operational staff, such as loan officers and administrative staff. Microcredit providers will have a clear and explicit assignment of responsibility for monitoring and ensuring appropriate senior management receive the information necessary to conduct their tasks. This may mean that a specific staff member or staff role should be responsible for compiling data and reports on relevant risks for the management on a regular basis. So the management of credit risk. Microcredit providers take into account credit risk when deciding on the following features of the loan product. Eligibility requirements will be based, in part, on criteria known to alleviate credit risks involved in lending to vulnerable groups or individuals. These criteria will differ for different countries, but may include producing a viable business plan, relevant business and household documentation like bank statements, receipts, and also having relevant experience or training. Loan amounts will be within a customer's ability to repay. Loan amounts should be based on a realistic assessment of disposable income, allowing for fluctuations in income and including an allowance for other debts. Providers operating will automatically increase loan sizes to entice repeat business should also take into account the customer's ability to repay. Loan terms will be sufficiently long to allow for affordable instalments. The repayment term of the loan should be adjusted to the underlying useful life of the asset being financed and the purpose of the loan. Repayment frequency will be sufficiently frequent to install repayment discipline in borrowers. Greater repayment frequency allows for greater control and oversight of credit risk. At the same time, the repayment frequency should take into account transaction costs for the provider and the borrower and the type of loan. Microcredit providers will consider using non-traditional collateral and/or collateral substitutes to reduce credit risk. Collateral is an important mechanism for reducing credit risk. The provider should therefore consider whether demanding collateral on balance is an appropriate and cost-effective way of limiting credit risk in the circumstances in which it operates. Microcredit providers will take into account risk in the pricing of their products. The interest rate should, at least in part, reflect the level of risk and costs involved in delivering the loans. This is, of course, not the only factor in determining, as the level of interest rate may also be influenced by national interest rate caps, funding arrangements, and affordability of loans for borrowers. Microcredit providers will limit credit risk by requiring that at least 2 people approve all loans. This clause is important because requiring 2 people to approve loans is one of the most widely recognized ways of reducing the number of poor or fraudulent lending decisions. This will include loans that are rescheduled and refinanced. One of the people approving the loan may be a loan officer. Microcredit providers will limit credit risk by reviewing the aggregate exposure of the provider to any particular concentrations of groups of borrowers whose ability to repay could well be similar. Relying on a narrow range of borrowers could potentially leave a provider at risk of high default rates triggered by events affecting a particular group, such as geographically concentrated, economic downturns, sector-specific changes like new regulation or increased competition, and natural disasters. The concentrations of borrowers could include, but not be limited to, sector or geographic location. This review may be conducted by the management and the board. The review should consider the impact on the risk exposure of the provider, if the provider should and could take measures to prevent over-reliance on a particular borrower group, and what these potential measures could be. For example, diversification of the portfolio, expanding into other geographical markets. It is recognized that microcredit providers typically target vulnerable groups and that this may lead to concentrations of groups of borrowers with similar repayment abilities. This does, of course, not mean that providers should avoid lending to these groups. Microcredit providers operating with staff incentives should ensure that these are not exclusively linked to loan origination, but also to portfolio quality. The reporting standards, globally, the consensus is increasingly underlining that a greater degree of public disclosure and transparency is the best way of promoting better use of public and private funding and greater market discipline. To facilitate comparisons of the performance of microcredit providers, financial reporting standards have been developed through international consensus. This section of the code sets out a set of common standards for the reporting and disclosure of social and financial performance indicators. These are largely based on definitions of the Microfinance Information Exchange, MIX, as it's known, which are based on internationally accepted accounting standards. So the common financial reporting standards are that microcredit providers across Europe will adhere to the following definitions when measuring and reporting the following indicators. Their current portfolio, which refers to the outstanding value of all loans that do not have any instalment of principal past due, excluding accrued interest. The gross loan portfolio, which refers to the outstanding principal balance of all outstanding loans, including current, delinquent, and restructured loans, but not loans that have been written off or interest receivable. Net loan portfolio. Net loan portfolio is calculated by subtracting the impairment loss allowance for the gross loan portfolio. And active borrowers refers to individuals who currently have an outstanding loan balance with a microcredit provider or are primarily responsible for repaying any portion of a gross loan portfolio. Individuals with multiple loans with a microcredit provider should be counted as a single borrower. It's also financial review. The financial revenue includes revenue from a loan portfolio and from investments. Financial revenue from a loan portfolio refers to revenue from interest earned, fees and commissions on the gross loan portfolio only. It includes interest paid in cash and interest accrued but not yet paid. Financial revenue from investments refers to revenue from interest, dividends or other payments generated by financial assets other than the gross loan portfolio, such as interest-bearing deposits, certificates of deposit and treasury obligations. Operating revenue includes all financial revenue and other operating revenue generated from other financial services such as fees and commissions for non-credit financial services not considered financial revenue. It might include revenues linked with lending such as membership fees, ATM card fees, transfer fees or other financial services such as payment services or insurance. It may also include net foreign currency gains or losses, but it does exclude donations and revenue not generated from provision loans and financial services. It's also personal expense, covers wages, salaries, other short-term employee benefits, post-employment benefit expenses. There's administrative expense, which covers non-financial expenses, including personnel directly related to the provision of financial services or other services. Then there's financial expense. This includes all interest, fees and commissions incurred in all liabilities, including deposit accounts of customers held by an MFI, commercial and concessional borrowings, mortgages and other liabilities. Portfolio at risk, PAR. This clause has been identified as a priority because it's most widely recognised measure of the portfolio quality. This refers to the value of all loans outstanding that have one or more instalments of principal past due more than a certain number of days. It includes an entire unpaid principal balance, both past due and future instalments, but not accrued interest. It does not include loans that have been restructured or rescheduled. Providers should at least measure PAR 30 or 45 days. You also have write-offs, value of loans recognised as uncollectible for accounting purposes, impairment loss, allowance and provision expense. Impairment loss or loan loss allowance is the portion of the gross loan portfolio that has been provided for in anticipation of losses due to default. Assets, sum of property, plant and equipment, investment property, goodwill, intangible assets other than goodwill, other financial assets. And then there's liabilities, the sum of total trade and other payables, provisions for employee benefits, current tax liabilities, deferred tax liabilities. You also have operational sustainability ratio. This clause has been identified as a priority clause because it's a core indicator of performance of a microcredit provider. It measures the extent to which a provider is covering its costs through operating reviews. This is calculated using the formula operating revenue, financial expense plus loan loss provision expense plus personal expense plus administrative expense. You also have financial sustainability ratio, which measures how well a provider is covering its costs through operating revenues, taking into account subsidy adjustments. Subsidy adjustments are hypothetical revenues and expenses which take into account subsidized costs of, adjustments to sustainable ratios taking into account subsidies. Subsidised costs of funds and in-kind subsidy. The subsidised cost of funds adjustment tries to account for the difference between an MFI's financial expense and financial expense it would pay if all funding were priced at market rate. So what are some common social reporting standards? Microcredit providers will, on an annual basis, publicly disclose the following indicators. Their social mission. This clause has been identified because disclosing the social mission is important for enhancing transparency around a key aspect of the provider's business model. Their average disbursed loan size, the median disbursed loan size as a percentage of gross national income, the percentage of female customers if relevant for target market and mission, the percentage of rural customers if relevant for target market and mission, percentage of customers below the poverty line if relevant for target market and mission, the percentage of customers graduating to mainstream finance, the percentage of ethnic minority or indigenous customers, if relevant for target market and mission, the percentage of startup businesses funded, and the percentage of customers on welfare benefits. So the management of information systems, according to the 1998 CGAP Handbook of Management Information Systems, MIS, a management information system is the series of processes and actions involved in capturing raw data, processing the data into usable information, and disseminating the information to users in the form needed. An effective and appropriate MIS can enable microcredit providers to serve their customers with greater efficiency and reliability. This section of the code sets out common standards for the MIS of providers regarding completeness and expandability in terms of functions, security, and staff support. So the functional completeness and expandability. Microcredit providers will have an MIS that is capable of producing the data necessary for the following key management, operational, and financial reports: income statement, the balance sheet, the daily loan and delinquency reports, ratios, and trends. Microcredit providers will have an MIS that enables the provider to perform a full range of accounting activities. This includes loan loss provisioning and tracking, cash flow, revenues, and expenses. Microcredit providers will also have an MIS that operates in accordance with generally accepted accounting principles and recognized accounting standards. Microcredit providers will have an MIS that is able to monitor and manage loan portfolio quality and functions. Microcredit operators will have an MIS that is able to manage and maintain information about clients, including names, addresses, historical data, customer data, and relevant social performance indicators. Microcredit providers will have an MIS that is capable of facilitating prompt access to relevant information from management, lending staff, and board members. This does not necessarily mean that the manager, loan staff, or board members have to be able to access this information directly through their MIS. Rather, it means that the MIS should be capable of producing relevant information for all of these groups. The microcredit providers will have an MIS that is capable of handling and incorporating new products, multiple offices, services, and delivery channels. This will include separating and aggregating office-level data, new lending methodologies, currencies, and various types of interest rates. This applies to providers that operate with or have plans to operate with various products, offices, services, and delivery channels. And they also, microcredit providers will, if applicable, and part of the plan of the institution, have an MIS that is able to cope with planned growth. This includes growth in volume, length, and new branches. So the microcredit providers will restrict access to the data captured by the MIS through use of appropriate security systems. This may include PIN codes, changed regularly, IP control, and equivalent measures. Microcredit providers will operate with different levels of user access and reporting, with functions reserved for specific user levels integrated into the user interface. A key aspect of this is that one person should not be able to go through a whole process alone. The providers will have provisions in place to store completed transaction balances and statements safely and restore information if necessary. This may include regular backups and built-in recovery mechanisms. Microcredit providers also have an MIS that is able to perform regular backups. Backups refer to making copies of computer programs and files so that these can be used to restore the original files if there's a data loss or event. Microcredit providers will have an MIS that is able to produce an audit trail on crucial processes and data changes. The system should identify who has performed or signed off certain key actions, such as dispersing loans, changing loan amounts, and rescheduling loans. The microcredit providers will provide training and/or manuals to support the MIS users. So we thank you very much for your attention and happy learning.